Well, hello, Maverick Traders. This is Rob, and we are now jumping into cryptocurrencies. All right, before I go any further, I feel like I need to come on and air my dirty laundry and say I was not a believer in cryptocurrencies in the beginning. In one of our Maverick summits, this was back in 2014 or 15, I had one of our foreign currency traders come up to me and tell me about Bitcoin and about cryptocurrencies. And I had learned a little bit about them. I knew what they were about. And I specifically told them it's a joke and it's going to zero. So look, I am not a crypto believer in the beginning. I am a crypto convert for sure. And it really wasn't until about 2018 where I realized, oh, this isn't going away. This is becoming a thing. And I better get on board with it, whether I like it or not. So whether you've been a crypto believer from the beginning or a crypto skeptic, it doesn't matter where you came from. All that matters is now you're here. Let's talk about it. Now, the first thing I wanted to get into is what is money? Now, I'm going to start with this because this was the reason I wasn't a believer, that I didn't quite understand this concept yet. And I thought I did, but I really didn't. Now, if you have some money on you right now, I want you to take it out of your pocket. And if you're at a desk, put it on your desk. If you're somewhere else, I want you to just look at this piece of paper or a coin. And I want you to look at it and think about, why is it worth something? Okay, hopefully that just blew your mind a little bit. Now, if you're sitting at a desk, there's likely other pieces of paper there. They're not worth anything. You can't go to a store and give someone a blank piece of paper and go out with goods. It doesn't work. But yet, this piece of paper, this one little piece of paper, you can go in somewhere and someone will give you something of value for this worthless scrap of paper. Now, I hope that kind of really blows your mind. I really want you to think deeply about that. And I want you to recognize that, oh my gosh, this piece of paper is a social construct where they have convinced me, and I use they like it's some sort of conspiracy, but we'll get into it. But you've been convinced, and the world has been convinced, that these scraps of paper mean something. And the number that someone put on them means more. Okay, I know it's a lot deeper than that, but I want you to just recognize this fallacy of money that we have in our minds, that it's actually valuable. Now let's go through the history of money. Because at one time, money had value. It's because it was made out of a commodity. Now, it was made out of gold, silver, iron, bronze, whatever it is that people consider there were value. They would actually print these values. Now, over time, there's been lots of civilizations that have come and gone. But understand, if you are using commodity currencies, you could go to ancient Greece and get a 1 ounce stamped gold coin of whoever was the king of the Greeks at the time. You could then pass it down to your generation for 3 to 4 generations, and they could move to Spain. And in Spain, they could take out that 1 ounce coin and get something of value. Because the value wasn't in Greece. It wasn't in the government of Greece. The value of that is in the currency, is in the metal. So that's how currencies were started. Is they made them out of valuable metals. Next, and it was actually the Dutch that did this first. The Dutch actually were the first to make currencies. I think it was somewhere in the 1650s. And they made the first paper notes because back in the day when you needed to buy something, like let's say you were a merchant and you wanted to go buy thousands of dollars worth of goods, but the place where you're buying it was like 100 miles away. What you'd have to do is you'd have to get all the money that you needed to buy those goods in a big chest, get it in your wagon, hire armed guards, and hope that you didn't get robbed along the way and killed. That's how we've done it for thousands of years. Finally, the Dutch were like, hey, look, how about a better idea? How about we set up these agreements with banks that you come into the bank, you get this note, and then you can go all the way to the place you were buying goods, give them this note, and then they can go to their bank there or your bank there, show them this note, and they'll give you the gold and silver that you didn't have to transport. So that was the first time that paper currency was introduced, but it was still backed by something. It was still backed by this person had money in the bank. Now, governments started to get into the game, and once the governments got into the game, they started with an asset-backed currency, but then they actually decided, hey, we don't need to do it. So currency is very easy to understand when the value is in the middle. It's not in the stamp. It's not in the government. It's not in anything. Empires could rise and fall, and that gold will still be worth something. After the Dutch started to print these notes, governments started to print notes. Before, it was always banks that were making currencies. And the government said, hey, you know what? We're not going to have banks do this. We're going to do this. Now, this is an old silver note in the US. And this is how currency used to work. I can't remember how many it was every like 10 or 20 bills that were printed in the United States. They would either print a silver note or a gold note. And the way these notes worked was that these were currency. And that if you had one of these notes, you could go into any bank at any time and plop down your $100 gold note. And in return, you would be given $100 worth of gold at the current price. That's what these notes signified. These notes you could take into any bank and you would be able to get that gold or get that silver immediately. So as you can see, this piece of paper still had value. As long as you could get it to a bank, give it to the teller, they would give you something of great value, gold or silver. All right, now that's how it worked for years. Then all of a sudden, in about the 1930s, governments, specifically the United States, said, you know what? We have to have all this gold and silver just to print more money. Because every time they wanted to print more money, they had to buy more gold and silver. Because they had to have a certain amount of gold and silver for every dollar they printed. And pretty soon the government's like, ooh, this is getting expensive, having all this gold and silver just sit there. We're going to leave the gold standard. Now, when the United States announced they were leaving the gold standard, there were prophecies of doom and gloom, and all of a sudden currencies aren't worth anything, and people called it funny money. Well, guess what? Here we are 100 years later, and everyone's fine. Nothing collapsed. Nothing happened. Nothing bad happened. So here we are. We're now living in a world of fiat currency. There is no gold or silver. The governments can print whatever money they want. And now the value of a dollar is only based on one thing and one thing only: perceived value. Perceived value. Now, there are stories of currencies. The latest one is the Zimbabwe dollar. I actually have a $100 trillion. Yeah, I know. It's such a good brag. You've got to get one of these. Go on eBay. You can get one of them for like $5. They're awesome. I have a $100 trillion note from the Bank of Zimbabwe. I'm serious. Go on eBay and buy one. It's hilarious. I've got it framed in my office. It's pretty funny. But what happened was the government decided, hey, let's just start printing more money and then we could pay off all of our bills. Well, what happened is the money goes to zero. The money has no value whatsoever. And one of my favorite stories is in Zimbabwe, there was a gentleman who had a wheelbarrow full of Zimbabwe dollars, like full to the top. And he was like going down this village and two men came out of the alley, knocked him down, punched him, grabbed the wheelbarrow full of money, dumped the money out, and ran off with the wheelbarrow. Because the wheelbarrow was the only thing of value. So fiat currencies, once people don't believe it's worth anything anymore, it isn't. And as long as people think it's worth something, it is. Perceived value. So let's go back to the first slide where I said, what is money? What is money? Things like value and worth are nothing more than social constructs based on today's reality. At one point, the Zimbabwe dollar was worth something. And at another point, it was not. The only thing that changed was perceived value. So once you understand the illusion of value, you really start to understand how you want to sell things that aren't working and you want to hold things that are working because everything is based on perceived value. So let's really talk about why does a paper bill, why does a $100 bill from the United States government, why do people think it has value? Number one was typically people have to work to get that money. So one of the biggest reasons why we all think that currency has value is because we've all had to put out a certain amount of our labor in order to earn one of these little pieces of paper. And so because of that labor that we put out there, it's perceived to have value. And we also trust the entity that printed it. We don't trust anyone's dollar bills. I mean, we could go down to Billy Bob's house and he could print you out a picture of his face and the $100 on it, and we wouldn't consider it worth anything. We consider it valuable because we trust the source. We trust the source and we trust that this government won't print endless amounts of money and make our money worthless. Now look, governments have done it. It's happened in the past. But we all understand that we're trusting the government to not print too much. And if it does print too much, we could get devaluation of the currency. Now here's the irony. A lot of people have been talking doom and gloom about the US dollar and about how the government keeps printing more money. But here's the problem with that argument. Every government has been printing more money. Remember, currencies are relative strength and relative weakness. If the dollar goes down in value, that means another currency has gone up in value. Currency trading, you're at the bottom. You're at a cash trade. You can't go any lower than cash. So if someone wants to sell yen, they have to buy another currency. And if they buy a commodity like gold or silver, that is denominated in dollars. So you're still buying another currency. If you want to buy stocks, all those stocks are denominated in another currency. And so the idea that, the US is printing so much money, look, I agree with you. But here's the problem. Every government is printing so much money. As long as we're not the worst house on the block, the US dollar is going to stay strong. Once it is the worst house on the block, then it will go down in value. But when you look around and see what Europe's doing, what other countries are doing, that's why I have no worry at all about the perceived value of the US dollar, at least at the moment. And then the last one, authenticity. Counterfeit. Like I said, we don't accept Billy Bob's money that he printed on his printer at home. We need it to be authentic. And so we want a government that is actively fighting against counterfeiting. Governments that don't fight against counterfeiting, people don't want their money because they're worried they're not getting an actual US dollar or an actual euro. So we want a central authority we trust. We want to trust that they're not going to print so much money to make our piece of paper worthless like it actually is. And we want them to fight counterfeiting and make it to where when we get a dollar, we're very convinced that it's real. That's why we have perceived value. So let's talk about currency. So here's the craziest thing about it. So a lot of people say, but Rob, I don't get cryptocurrencies because I can't hold it. I can't hold it. I can hold a $100 bill. I can hold it. I can understand it. This just seems like funny money. Well, I say, well, guess what? That's all money is. And in fact, most of the money in the world, it's already digital. So these are just some numbers of how much of the country's currency is in digital format. So in the United States, only 10.2% of all US dollars are actually printed in paper and coins. 89.8% of it is a ledger somewhere in a spreadsheet. In a bank ledger, there's not 100% of the currency that's printed out. It's a very small amount. And if you look around the world, you'll be surprised at how little actual currency there truly is. In the Eurozone, there's only 4.1% of actual currency that's been printed. In the UK, 4%. 96% is digital. Look at Canada. Canada, 2.7% of its currency is actually printed. The rest is digital. So for any of you that are having a hard time grasping cryptocurrencies because it's digital, we're there. We're already there. The US dollar is vastly digital. When you send a wire somewhere, you're not actually sending money. You're sending a computerized code that changes a number in a ledger. That's it. That's all money is anymore. It's all digital and it's all fiat. So once you understand that we're already using digital currencies in every single world and hardly any of it is in paper form, and it's all just a made-up game of what currency is worth what, then all of a sudden, you can actually start to get your head around cryptocurrencies. Here we are. We're in the world of crypto here. Let's go through the same test that we put with why you believe that paper money is worth something. Perceived value. Now, here's kind of a great difference, and one of the reasons why people do love cryptocurrencies. The first time I talked about perceived value of actual currency, I talked about a centralized authority, meaning there was a government you could trust. One of the things that is a real drawing point to cryptos is that it's a decentralized authority. People don't want to trust the governments because they've seen governments sometimes print too much. So they've really enjoyed a currency that doesn't have government intervention. It has hard and fast rules. Like Bitcoin. Bitcoin has a hard and fast rule that there will never be more than 21 million Bitcoin mined. That's the most that will ever be done. No one can get in there and change the code. No committee can decide, hey, let's do 30 million. No one can do that. It's literally hard-coded into the program. People love that. Now all of a sudden it's like, okay, we know that this cryptocurrency can't be printed into oblivion. We know that there's going to be limited supply. So everyone knows how they're made, when they're made, how many can be made. Now people can look at a currency and say, okay, at least I know what the supply is going to be a year from now, 10 years from now, 20 years from now. When you look at a government currency, you have no idea. You have no idea what they're going to do. These are hard and fast rules that people like. And then the last one, authenticity. Authenticity. We talked about counterfeiting. We talked about that with paper money, and the governments that fight counterfeiting very well, their currencies tend to hold up in value better, especially under times of stress. So when we talk about cryptocurrencies, how in the world do you know you're getting an authentic token? Well, the answer to that question is the blockchain. The blockchain is what ensures that you're getting an actual token. So let's talk about blockchain technology. When Bitcoin was created and then other cryptocurrencies after that, I heard a lot of people say, okay, well, these cryptocurrency coins, okay, whatever, they're kind of weird, but the real beauty of this technology is the blockchain. And I've heard so many people say the blockchain is going to solve a lot of our problems. People say we're going to use it in voting. People say we're going to use it in banking. This is where the future is going. So what blockchain is, it's basically a ledger of transactions that is held on everyone's system around the world. So imagine every single computer in the entire world connected to the internet. And they're constantly checking against everyone else's numbers to make sure the numbers are right. So let's say someone did try to change a code somewhere. Someone tried to go in on their system and change a code. it's not going to work because there's 4 billion computers around the world that say, no, that doesn't match up. We're going to kick that one out. This is the blockchain technology, and it's really cool. And so the way it works, and we're going to get into this later when we get into the World Currencies series, we're going to talk about all these things like how do you mine a cryptocurrency. But let me give you just a slimmed down version. In order to mine a new token, in order to create a new Bitcoin token, a new Ethereum token, you have to go through a process called mining. And basically it's heavy duty, complex math problems that you basically have to build out these ledgers that are very, very complex. And once you've built out these ledgers all the way, you get rewarded with the coin. And now that coin, you've created the ledger for that coin, and now that ledger is public knowledge on everyone's system. So again, it takes work. In order to create a coin, it takes a lot of work. People are spending hundreds of thousands of dollars on server farms, on electricity. This takes a lot of work and effort to just mine a coin. Again, just like when you go to work to get that dollar bill, you put work into it so you perceive it has value. There's a lot of work that goes into creating a cryptocurrency. All right, now I kind of wanted to go through, just take some experiences that you're already familiar with and kind of show you that cryptocurrencies make a lot of sense when you look at it this way. So let's say that you go to a store and you have your debit card. Now look, that debit card's not money. Everyone knows it's not money. Everyone knows it's a piece of plastic. So why in the world would anyone take that piece of plastic and give you some new shoes? Because they're going to check on that piece of plastic. So what happens is you go to the store, they run the credit card. What you don't know is behind the scenes, that credit card is sending its signal to the bank that retailer uses. So you're at the store, the retailer has used a bank or some sort of financial institution. What that store does is that bank goes and communicates with your bank and says, hey, we just got this number. It's from your bank, and they're trying to buy a shirt or shoes for $100. Do they have $100 in this account? And the issuing bank will say, well, no, they don't. And if that's the case, then the credit card will get declined. If the bank says yes, then what will happen is it will get approved. Ledgers will be changed. So all of a sudden, your bank account has $100 less in it. The acquiring bank account has an extra $100 to it, and they're going to pass that on to the store. That's a digital transaction. We all understand that that happens all the time. Let's take one more thing. Now, hopefully you have received one of these dollars before. So for those of you that are younger, like my son, my son will get paid in cash sometimes, or else like grandma will give him like cash. And he comes up to me and he's like, Dad, I don't know what to do with this. Can I convert this into digital money for you? So he'll give me the $20, $50 bill, and I will Venmo him $20 or $50. He doesn't want it. He does not want the cash. So maybe if you're young, you don't do a lot of cash transactions, but every so often you will come across one of these dollar bills, and someone has just simply put a stamp on it. And it says, track me at www.where'sgeorge.com. So if you go to this site, you actually take the serial number from that dollar bill and you put it in, and it will show you all the places that people have logged this. So I just want you to take a look at this one. This one's, I thought, was actually kind of interesting and cute. So again, you put in the bill number. This bill has traveled at least 13,905 miles in 7 years. And so you can actually see it started down here. And again, I wasn't able to capture all of this, but it started in Miami. And you can see that the user will go in and say, hey, I got this at Mango's in South Beach. Well, the next time it popped up was in Atlantic City, New Jersey at Harrah's Casino. And then the next time it popped up, it went to Pennsylvania. And it says, oh, my friend gave it to me. She got the bill at Atlantic City. Okay. Next, it went to a gas station in Missouri. Next, it went to South Dakota. It was in a tip jar at a diner. All of a sudden, South Dakota, it was given as change at a hamburger shop. Then it went to Vegas. Then it went to Arizona. And then it went to Texas. Okay, so this is what people have done. They put the stamp on, and then people who find it, they get online and they log in. Hey, this is where I got it. And you can actually start to see where some of this has gone. That is literally the blockchain. That is literally the blockchain. This is the best example I can give you for it. So we get to see, it's a public ledger. We get to see when and where the token was produced. We get to see every single transaction that token has gone through. And again, this makes it authentic, just like digital money. So, like I said, I was not a believer in cryptos. I have to be fully honest with that. I was not on board till like 2018, maybe late 2018. And then I realized, a lot of people believe this. A lot of people believe this is real money. I don't. But if enough people believe it's real money, guess what? It's real money. And I understood, this is about to become its own asset class. This is where people are going to start to say, okay, well, I'm going to put 20% of my money in stocks, 30% of my money in real estate, and 10% of my money in crypto. And in fact, I think that the money that used to go into gold and silver, again, people would buy those because it's a hedge against inflation. And again, hedge against inflation, meaning the government printing too much money. People say, okay, if the government's printing too much money, I want to put it in gold because there's only so much gold in the world. There's a limited supply. I really feel that some of the money that used to go to gold and silver is now going to cryptos. And people are really counting on this as being a store of value, especially against inflation. So whether you're already a believer or whether you're a convert, and if you weren't a believer coming into this, hopefully I've made you a convert. Remember, money is a social construct. The $100 bill in your pocket is paper. It's worthless. It's only meaningful because enough people think it's valuable. There's enough people that now believe that crypto is valuable, that it is valuable. When you first get started in cryptocurrency trading, just like in forex, some terms are a little bit different. So let's just go through some of the basic terms so we can all get on the same board. So when we start to talk about trading it, there's no confusion as far as what the terms mean. All right, well, let's take a look at some of the major cryptocurrencies. Now, a couple years ago, there was only a handful of cryptocurrencies. Now there's endless cryptocurrencies, and everyone's making a new cryptocurrency every other day or every other minute. We're not going to focus on those because we want all the things that we believe make a currency worth money. We need to have that in order to make it an actual investment and tradable vehicle. So we're going to take a look at Bitcoin, Bitcoin Cash. Again, we have more information on all these currencies, how they started, what they're about, what their correlations are in our World Currency series. So right now we're just introducing the coins. If you want more information, you'll absolutely get very in-depth information on all these. So Bitcoin, ticker symbol BTC, Bitcoin Cash, BCH, Ethereum, ETH, and Litecoin, LTC. Now, yes, I know there's lots of other currencies out there, lots of other cryptos. My advice is stick with the big ones. Stick with the big ones. They've got the most volume, the most liquidity. Remember, liquidity, if you start to trade things that are illiquid, whenever there is a panic, you may or may not be able to get out. Or you might be able to get out, but the slippage is going to be so big. It's huge. We want to trade things that have lots of liquidity. So we're going to stick with the big ones. Just like with foreign currencies, guess what? Every single cryptocurrency is a pairs trade. So when people say Bitcoin, what they're really talking about is Bitcoin versus the dollar. So whenever you hear someone say, Bitcoin is up 100 points today, they're really meaning to say Bitcoin dollar. So Bitcoin dollar, you'd want to buy this if you thought Bitcoin was going up and the dollar was going down. Now you can cross these against other currencies, but you never hear someone say, Bitcoin went up 100 points. They're talking about Bitcoin dollar. But you can buy Bitcoin euro, You can absolutely buy Bitcoin Euro. So the only time you'd want to buy this is when your analysis shows you that Bitcoin is likely to be the strongest currency of all the other currencies you look at, and the euro is the weakest currency of all the other currencies you look at. So just like foreign currencies, it's a currency cross, and we can trade these just like we trade everything else. Now let's talk about where we trade these. When we talked about forex, we talked about the interbank market. And we talked about how all the banks form this huge exchange of network to where we can go in and buy and sell currency from that bank network. Basically, the same thing has been created in cryptocurrencies, but instead of banks doing it, we've had exchanges do this. So basically, somebody set up an exchange. They got a whole bunch of people to believe that their exchange was a good place to buy and sell crypto. And as long as there's enough volume there, there's an exchange. So it's not centralized. There is no central exchange. There's actually no communication between exchanges. The governments are late to the party as usual. There's not a lot of regulations. There's not a lot of rules. That's likely to change. But for right here, right now, you're really just trusting in private companies to do the right things without a lot of government oversight. Now, look, some people love that. Some people love it. I agree that government can be cumbersome and can overregulate at times, but there's also times that they're underregulated and we should do something. So that's definitely going to change over time. It happened in the foreign exchange market. We had no regulation up until about 2011. And then we got regulation and nothing really changed. It's the same thing. Things go up and down based on supply and demand. So again, it's one thing that's definitely going to change in this, but it's nothing to be worried about. You're going to hear the term digital wallet. Now, if that sounds super fancy, I want you to exchange that with bank account or exchange it with brokerage account. It's the same concept. It's your account. So whenever you hear the term digital wallet, it's literally your account. So let's go over some of the exchanges. So again, here's one of the problems with cryptocurrency is that all of these exchanges have different participants. So let's say that you are a client of Coinbase. And so every time you go to buy and sell, you are buying and selling on the Coinbase exchange, meaning that Coinbase has to have a seller. If you want to buy a cryptocurrency, there has to be a seller in Coinbase's network or else the trade doesn't go through. So you can see you want a lot of people participating in an exchange to make it worth your while to go there. And if not a lot of people go there, there's not going to be very good prices. And here's the problem is that there's going to be different supply and demand profiles on all of these. So at Coinbase, you could see that maybe it's $3.25 is the cryptocurrency you're trading. But if you go over and look at a quote from someone like Bitstamp could be at $3.26. And then you could go to Kraken and it's trading at $3.20. So here's the question. Where is it at? What is the correct price? And the answer is, it is the correct price at that exchange based on the current supply and demand at that exchange. Now look, this is something that has gotten a whole lot better over time. In the beginning, there could be pretty wild differences between prices on exchanges. And that was one of the things that really scared me away from cryptocurrencies is because I said, I don't know what the price is. How can I buy or sell something if my exchange says it's at 330 and your exchange says it's at 320? That's a 3% difference. How do I know I'm not paying $3 too or 3% too much? Now, what has happened, and it's happened from two things. More participants have joined exchanges. So the more people you have in an exchange, the more price discovery you have because a lot more people are participating in it. And also you've got professionals coming in doing what's called arbitrage. What they would do is they would come here and say, oh, wow, Kraken is at 320 and over at KuCoin it's at 330. They would go in and buy at 320 and then sell over here at 330 immediately. So it would drive the price up at Kraken and drive the price down at KuCoin. and they would end up meeting up. This is just called arbitrage. So whenever there is a situation like this where there's price differences, there's a whole bunch of professionals out there that are looking for these examples. And when they go in and they take advantage of it, it closes these gaps. So this is something that is much better, but understand there is no centralized exchange. You're all on these private exchanges. So when you open up a crypto account, you are probably entering into an agreement with a company that is going to act as both your digital wallet and your exchange. Now, again, some only do one or the other, but most of the companies that you will interact with in your private life will be both. They'll be both the exchange and the digital wallet, which means you do want to go with the biggest, because the exchange with the most activity is going to have the tightest bid-ask spreads, which means that trading those products is going to be cheaper. Now, one term you're probably going to hear about when you jump into the world of crypto is cold storage. Now, cold storage is just like you decide you don't want your money in the bank. You don't think it's safe in the bank. So you go down to the bank and you say, give me my $10,000, and they literally give you $10,000. And you go home and you bury it in the backyard. That's cold storage. That's basically cold storage. So you can take your cryptocurrencies out of these exchanges, out of these digital wallets, and get them in a digital form. Now, again, it's with money, you get that $10,000 in paper. And again, you think it's worth something. In crypto, you get it in a digital file. And people will put it onto something like a thumb drive or a desktop, and that's where their money is, and they feel like it's safer there. Let me tell you a crazy, crazy story. There was a man in Germany who bought some Bitcoin early on, and he put it on a digital wallet, a cold storage wallet, and this wallet had a security system on it that he was only allowed 10 tries at the password. After 10 tries, it would destroy the contents of the disk. So he did this years ago and totally forgot about it. And then all of a sudden, Bitcoin started to go up and up and up and up and up. And he's like, oh my gosh, that is now worth $250 million, but I can't remember the password. So he is at try number 8. He has made 8 out of the 10 tries, and he is now hiring psychologists, hypnotists, somebody to help him out. That story is just absolutely crazy to me. I just wanted to share that story with you. I just thought it was bonkers. Let's do a quick little example of a cryptocurrency trade. Now, cryptocurrencies, super easy because you don't need to know about lots. You don't need to know about pips. You don't need to know about anything else. You're literally just saying, I want to buy $10,000 worth of Bitcoin. So here's an example. Buy $10,000 worth of Bitcoin, and the current price is $40,900. So if you did that, you basically are owning 0.2449878 Bitcoin. That's how many coins you own. It doesn't really matter. We just look at dollar amounts. So you just buy it. Buy 10,000. Again, every time you make a trade, there's going to be a bid-ask spread. The bid is where you sell, the ask is where you can buy at the market. There's always a little difference. So if you wanted to buy immediately and sell immediately, you would actually lose money because of this spread. We want to trade with companies that have very, very small bid-ask spreads. We talked about how advantageous it is in foreign currency with the pipette. I mean, pipette spreads are it's so cheap to actually get in and out of these positions. All right, so you bought Bitcoin, you sold it. So you sold it at exit price a couple of days later at 46,238. And basically you made 5,300 points. Okay, but that doesn't really matter. What we're looking at is what is your rate of return? You made 53.38 and you bought it at 46,238. So your rate of return on this is 11.5%. So you put in $10,000, you made 11.5%. That's your return on the trade. So again, it's very, very simple with Bitcoin because you're just trading or sorry, with all the cryptos, you're just trading US dollars. Very simple. All right. So going forward, these cryptos are just going to be another currency. That's all it is. We went through Japanese yen, US dollar, Australian dollar. Now look, all of these currencies are going to have different personalities. Some of them do better when other things happen. Some do well when the economy is good. Some do poorly when the economy is good. Some do well when oil goes higher. Some don't do well when gold goes lower. You're going to be learning all of the personalities of these coins, but in the end, the cryptos are just another coin, just another currency for you to pair up. And remember, your job as a trader is to buy the strongest currency during your desired time frame of holding the trade and pair it against the weakest currency. It all comes back to relative strength and weakness. So there will be periods of time where none of these coins, none of these currencies are good trades. We're just going to go to one of our other ones. Hey, if the cryptos aren't moving right now, hey, we'll just go take a look at the yen against the Australian dollar. That's the one that's working right now. As a trader, we don't care. We're just trying to find the strongest and the weakest. As a review for cryptocurrencies, there are 4 major cryptocurrencies we are going to focus on: Bitcoin, Bitcoin Cash, Ethereum, and Litecoin. Yes, there are other cryptocurrencies out there. I'm aware of it. We're going to avoid those until they get a little bit more volume and a little bit more accepted. Crypto trading is still a pairs trade. So it's simply one of the currencies that we either want to go long and pair it up against something else on the short side. And just like forex trading, trading is trading. Everything is a symbol that has a market price, and that market price is going to go up and down due to supply and demand. So as you can see, here are our currencies to choose from. We just simply have to pair them up, buy them, sell them at the right time, and build our strategies around them. Thanks for joining me for Module 1, everyone.